Recent shifts in U.S. tariff policy could add $1.1 trillion to federal budget deficits over a 10-year period, according to the director of the Congressional Budget Office. This video will explain how tariffs impact government finances and why history warns that these changes may have far-reaching economic consequences. Let's start with what's happening today. The United States has recently implemented various tariff measures aimed at protecting domestic industries and reshaping trade relationships with other countries, particularly China. These tariffs are designed to generate revenue for the government by taxing imports. However, they also increase costs for businesses that rely on these imported goods, which can lead to higher prices for consumers and potentially reduce consumer spending. To understand why this matters, let's look at a historical parallel. The Smoot-Hawley Tariff of 1930. The Great Depression had just begun when President Herbert Hoover signed into law one of the most notorious tariffs in American history. This tariff raised import duties on over 20,000 foreign goods and led to retaliatory measures from other countries. The result was a severe contraction in international trade that worsened economic conditions both domestically and globally. The Smoot-Hawley tariff is a stark example of how protectionist policies can backfire by reducing overall demand for goods and services. In the 1930s, this resulted in lower tax revenues as businesses struggled to stay afloat due to decreased sales. Similarly, today's tariffs are expected to have complex effects on government finances. While they might bring in some additional revenue from import taxes, they could also dampen economic activity by raising costs for consumers and companies. So why does this pattern keep repeating? One reason is the inherent trade-off between short-term protectionism and long-term economic health. Governments often implement tariffs with the intention of shielding domestic industries from foreign competition or to balance trade deficits. However, these measures can lead to a reduction in overall economic activity as higher costs impact both businesses and consumers. The non-obvious insight here is that while tariffs may protect certain sectors in the short term, they often result in broader economic contraction over time by reducing demand for goods and services. The trade-off between protecting domestic industries and maintaining robust economic growth is complex and not always straightforward. To summarize, today's tariff policy changes could inflate the U.S. deficit by $1.1 trillion over 10 years, according to experts. This video has mapped out how tariffs can impact government finances using historical parallels like the Smoot-Hawley Tariff of 1930 and explained the trade-offs involved in such policies. By understanding these patterns, viewers can gain clarity on the potential long-term consequences of current tariff measures. Tags, tariffs, deficit, economy, protectionism, Smoot-Hawley.